Question 1. An investor purchases a bond with a coupon rate of 5% that matures in 10 years. The bond is currently trading at a discount. Which of the following statements about this bond is true? A. The bond's nominal yield is less than its current yield. B. The bond's current yield is less than its yield to maturity. C. The bond's yield to maturity is less than its coupon rate. D. The bond's nominal yield, current yield, and yield to maturity are all equal. Answer: A. The bond's nominal yield is less than its current yield. When a bond trades at a discount, its current yield and yield to maturity, YTM, will be higher than its nominal yield, coupon rate. The nominal yield is simply the annual interest rate printed on the bond, while the current yield takes into account the bond's current market price. For a discount bond, the annual interest payment divided by the lower market price results in a higher current yield compared to the nominal yield. This relationship is crucial for understanding how bond prices affect returns. Question 2. A bond's call feature is most beneficial to which of the following? A. The bondholder. B. The bond issuer. C. The bond underwriter. D. The bond trustee. Answer: B. The bond issuer. A bond's call feature allows the issuer to redeem the bond before its scheduled maturity date, typically at a specified price. This is advantageous for the issuer if interest rates decline, as they can call in the old, higher interest bonds and reissue new bonds at a lower, more favorable rate. For the bondholder, a call feature presents reinvestment risk because they may have to reinvest their principal at a lower rate. Remember, the call feature primarily benefits the entity that borrowed the money, not the one who lent it. Question 3. Which of the following types of bonds is most sensitive to interest rate risk? A. Short-term bonds. B. High-coupon bonds. C. Zero-coupon bonds. D. Callable bonds. Answer: C. Zero-coupon bonds. Zero-coupon bonds are highly sensitive to interest rate risk because they do not pay periodic interest. Instead, they are purchased at a deep discount and mature at par value. The entire return comes at maturity, meaning their duration is equal to their maturity. Bonds with longer durations, like zero-coupon bonds, experience greater price fluctuations for a given change in interest rates compared to bonds that pay regular interest or have shorter maturities. Keep in mind that the longer the duration, the greater the price volatility. Question 4. An investor owns a municipal bond issued by a city within their state of residence. The interest received from this bond is typically A. Taxable at the federal, state, and local levels. B. Exempt from federal tax but subject to state and local taxes. C. Exempt from federal, state, and local taxes. D. Subject to federal tax but exempt from state and local taxes. Answer: C. Exempt from federal, state, and local taxes. Interest income from municipal bonds is generally exempt from federal income tax. Furthermore, if an investor purchases a municipal bond issued by a state or local government within their own state of residence, the interest is typically exempt from state and local income taxes as well. This triple tax-exempt status is a significant advantage of municipal bonds for many investors, making them attractive for those in higher tax brackets. Always check the specific bond's prospectus, but this is the general rule for in-state municipal bonds. Question 5. The coupon rate of a bond primarily determines the A. Bond's market price. B. Bond's yield to maturity. C. Annual interest payment the bondholder receives. D. Bond's credit rating. Answer: C. Annual interest payment the bondholder receives. The coupon rate is the stated annual interest rate on the bond. To find the actual dollar amount of interest paid each year, you multiply the coupon rate by the bond's par value, usually $1,000. For example, a 5% coupon bond with a $1,000 par value will pay $50 in interest annually. This fixed payment is independent of the bond's market price fluctuations. Question 6. A corporate bond is quoted as 98.5. What is its dollar price? A. $98.50. B. $980.50. C. $985. D. $9,850. Answer: C. $985. Corporate bonds are quoted in points, with each point representing $10, and fractions of a point expressed in eighths. A quote of 98.5 means 98.5 points. To calculate the dollar price, multiply the whole number by $10, 98 points x $10 per point equals $980, and then convert the fraction to dollars. 1/2 of a point equals $5. Adding these together gives $980 plus $5 equals $985. This method of quoting allows for precise pricing of bonds in the market. Question 7. All of the following are types of yield associated with bonds except A. Nominal yield. B. Current yield. C. Dividend yield. D. Yield to maturity. Answer: C. Dividend yield. Dividend yield is a term exclusively used for stocks, representing the annual dividend payment per share divided by the stock's current share price. Bonds, as debt instruments, pay interest, not dividends. The common types of yield for bonds include nominal yield, coupon rate, current yield, annual interest divided by market price, and yield to maturity, total return if held to maturity, considering price appreciation/depreciation. Understanding these distinct yield concepts is crucial for differentiating between equity and debt investments. Question 8. Which of the following is considered a secured corporate bond? A. Debenture. B. Subordinated debenture. C. Mortgage bond. D. Income bond. Answer: C. Mortgage bond. A mortgage bond is a type of secured corporate bond that is backed by real estate or other real property owned by the issuing corporation. This underlying asset provides collateral for the bondholders, offering them a higher level of security in the event of default compared to unsecured bonds. Debentures and income bonds, conversely, are types of unsecured debt, meaning they are backed only by the issuer's general creditworthiness. Always identify if a bond has specific assets pledged as collateral. Question 9. An investor selling a bond between interest payment dates will receive the bond's market price plus A. Reinvestment risk. B. Accrued interest. C. Call premium. D. Conversion value. Answer: B. Accrued interest. When a bond is traded in the secondary market between its interest payment dates, the buyer must pay the seller the bond's market price plus any interest that has accrued since the last payment date. This accrued interest compensates the seller for the portion of the upcoming interest payment that they earned while still holding the bond. This amount is then paid to the buyer on the next interest payment date, ensuring fairness for both parties. The standard calculation for corporate and municipal bonds uses a 360-day year. Question 10. The yield to maturity, YTM, of a bond reflects A. The annual interest payment as a percentage of the bond's par value. B. The annual interest payment as a percentage of the bond's current market price. C. The total return an investor would receive if they hold the bond until it matures, taking into account coupon payments, capital gains or losses. D. The return an investor would receive if the bond is called prior to maturity. Answer: C. The total return an investor would receive if they hold the bond until it matures, taking into account coupon payments, capital gains or losses. Yield to maturity, YTM, is the most comprehensive measure of a bond's return because it considers not only the annual interest payments but also any gain if the bond was purchased at a discount or any loss if it was purchased at a premium. YTM assumes the bond is held until maturity and that all interest payments are reinvested at the same rate. It provides a complete picture of the total anticipated return for an investor holding a bond until its final redemption. Question 11. Which of the following best describes a municipal bond? A. A debt security issued by a corporation to raise capital. B. A debt security issued by a U.S. territory, state, or local government to finance public projects. C. A debt security issued by the U.S. Treasury to finance the national debt. D. A debt security that allows the holder to convert it into shares of the issuing company's common stock. Answer: B. A debt security issued by a U.S. territory, state, or local government to finance public projects. Municipal bonds, often called munis, are debt obligations issued by states, cities, counties, and other governmental entities to fund public projects such as schools, roads, or sewer systems. Their primary appeal to investors is the potential for tax-exempt interest income at the federal, and sometimes state and local, levels. This tax treatment differentiates them significantly from corporate or U.S. Treasury bonds. Question 12. A bond trading at 105 is trading at A. Discount. B. Premium. C. Par value. D. Callable price. Answer: B. Premium. A bond's price is expressed as a percentage of its par value, which is typically $1,000. Therefore, a bond trading at 105 means it is trading at 105% of its par value, or $1,050. When a bond trades above its par value, it is said to be trading at a premium. Conversely, trading below par would be a discount, and exactly at par is par value. Question 13. Which of the following risks is associated with an issuer's inability to make interest payments or repay principal on a bond? A. Interest rate risk. B. Inflation risk. C. Reinvestment risk. D. Default risk. Answer: D. Default risk. Default risk, also known as credit risk, is the risk that an issuer will be unable to make timely interest payments or repay the principal amount at maturity. This risk is a significant concern for bond investors, as a default can lead to a complete loss of investment. Bond rating agencies, such as S&P and Moody's, assess and assign ratings to bonds based on their perceived default risk. Always consider the creditworthiness of the issuer before investing in bonds. Question 14. What is the primary characteristic of a zero-coupon bond? A. It pays interest semi-annually. B. It is callable by the issuer at any time. C. It does not pay periodic interest but is sold at a discount to par. D. It can be converted into the common stock of the issuer. Answer: C. It does not pay periodic interest but is sold at a discount to par. The defining characteristic of a zero-coupon bond, often called a zero, is that it does not make regular interest payments during its life. Instead, it is purchased at a price significantly below its par value and matures at par. The investor's return comes from the difference between the discounted purchase price and the full par value received at maturity. These bonds are particularly sensitive to interest rate changes because their entire return is realized at maturity. Question 15. The call protection period on a bond refers to the time during which the bond A. Cannot be sold in the secondary market. B. Is guaranteed to pay a fixed interest rate. C. Cannot be redeemed by the issuer. D. Is convertible into common stock. Answer: C. Cannot be redeemed by the issuer. Call protection is a specified period, typically a few years after issuance, during which a bond issuer is prohibited from calling the bond. This feature protects bondholders from early redemption, especially when interest rates decline, ensuring they continue to receive the stated coupon payments for a guaranteed period. After this period, the bond becomes callable, and the issuer has the option to redeem it. This protection is valuable to investors as it reduces reinvestment risk for a set duration. Question 16. A bond that allows the bondholder to exchange the bond for a specified number of shares of the issuer's common stock is known as A. Callable bond. B. Puttiable bond. C. Convertible bond. D. Revenue bond. Answer: C. Convertible bond. A convertible bond offers the bondholder the unique option to convert the debt security into a predetermined number of shares of the issuing company's common stock. This feature can be attractive to investors because it provides the safety of a bond with the potential for capital appreciation if the underlying stock performs well. Issuers often offer convertible bonds with lower coupon rates because of this added flexibility for investors. Question 17. Which of the following bond ratings indicates the highest level of creditworthiness and lowest default risk? A. BA. B. BBB. C. AA. D. AAA. Answer: D. AAA. Bond rating agencies like Standard & Poor's and Moody's assign letter grades to bonds to indicate their creditworthiness, which reflects the likelihood of the issuer defaulting. AAA, by S&P, or AAA, by Moody's, are the highest possible ratings, signifying excellent credit quality and the lowest perceived risk of default. Bonds with these ratings are considered investment grade and are typically purchased by institutions and conservative investors. Question 18. What is the relationship between bond prices and interest rates? A. They have a direct relationship. As interest rates rise, bond prices rise. B. They have an inverse relationship. As interest rates rise, bond prices fall. C. They have no relationship. Bond prices are independent of interest rates. D. They have a direct relationship for long-term bonds and an inverse relationship for short-term bonds. Answer: B. They have an inverse relationship. As interest rates rise, bond prices fall. Bond prices and interest rates generally move in opposite directions, reflecting an inverse relationship. When prevailing interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower coupon rates less attractive. To compete, the prices of older, lower coupon bonds must fall to offer a comparable yield to new investors. Conversely, when interest rates fall, existing bonds with higher coupon rates become more desirable, driving their market prices up. This fundamental concept is critical for understanding bond market dynamics. Question 19. A bond with a put feature is beneficial to the A. Issuer, if interest rates fall. B. Issuer, if interest rates rise. C. Investor, if interest rates fall. D. Investor, if interest rates rise. Answer: D. Investor, if interest rates rise. A puttiable bond includes a put feature, which gives the bondholder the right to sell the bond back to the issuer at a specified price, usually par, on certain dates before maturity. This feature is beneficial to the investor, especially if interest rates rise significantly after the bond's issuance. In such a scenario, the investor can put the bond back to the issuer and then reinvest the principal at the higher prevailing interest rates. This option helps protect the bondholder from significant capital depreciation due to rising rates. Question 20. Which of the following securities would generally have the lowest credit risk? A. Corporate bonds. B. U.S. Treasury bonds. C. General obligation municipal bonds. D. Revenue municipal bonds. Answer: B. U.S. Treasury bonds. U.S. Treasury bonds are considered to have virtually no credit risk, or default risk, because they are backed by the full faith and credit of the U.S. government, which has an unlimited ability to tax and print currency. This makes them the benchmark for risk-free investments in many financial models. While other bond types like corporate and municipal bonds are also generally safe, they carry a degree of credit risk that treasuries do not. Question 21. What is the meaning of discount when referring to a bond's price? A. The bond's market price is equal to its par value. B. The bond's market price is lower than its par value. C. The bond's market price is higher than its par value. D. The bond has been purchased at a reduced commission. Answer: B. The bond's market price is lower than its par value. A bond is said to be trading at a discount when its current market price is less than its par value, which is typically $1,000. This often occurs when prevailing interest rates have risen since the bond was issued, making its fixed coupon payments less attractive compared to newer bonds. When a bond trades at a discount, its current yield and yield to maturity will be higher than its nominal coupon yield. Question 22. Accrued interest on a bond is calculated from the A. Trade date to the settlement date. B. Previous interest payment date up to, but not including, the settlement date. C. Previous interest payment date up to, and including, the settlement date. D. Original issue date to the present date. Answer: B. Previous interest payment date up to, but not including, the settlement date. Accrued interest is the interest that a bond has earned but has not yet been paid out to the bondholder. When a bond is traded, the buyer pays the seller the bond's market price plus any accrued interest. This interest is calculated from the last interest payment date up to, but not including, the settlement date of the trade. The buyer will then receive the full semi-annual interest payment on the next coupon date. Question 23. A 6% bond trading at a discount would have a current yield that is A. Less than 6%. B. Equal to 6%. C. Greater than 6%. D. Not determinable without the bond's maturity date. Answer: C. Greater than 6%. The nominal yield, or coupon rate, is the stated interest rate on a bond, in this case, 6%. When a bond trades at a discount, its market price is below its par value. The current yield is calculated by dividing the annual interest payment by the bond's current market price. Since the market price is lower than par, dividing the fixed annual interest payment by a smaller number will result in a current yield that is greater than the nominal yield. Question 24. Which of the following terms refers to the specified date on which the principal amount of a bond is repaid to the bondholder? A. Coupon date. B. Settlement date. C. Issue date. D. Maturity date. Answer: D. Maturity date. The maturity date is the specific date on which the issuer of a bond is obligated to repay the bond's principal amount, par value, to the bondholder. This date is fixed at the time the bond is issued and is a critical characteristic, as it defines the bond's lifespan and when the investor can expect to receive their principal back. Understanding a bond's maturity date is key to assessing its duration and overall risk profile. Question 25. A bond that is backed by the full faith and credit of the issuing municipality, with payments coming from general tax revenues, is known as A. Revenue bond. B. General obligation bond. C. Industrial development bond. D. Special assessment bond. Answer: B. General obligation bond. A general obligation, GO, bond is a municipal bond backed by the full faith and credit of the issuing municipality, meaning it is secured by the issuer's taxing power. Payments on GO bonds are typically made from general tax revenues, such as property taxes or sales taxes. This broad backing usually makes GO bonds considered safer than revenue bonds, which are backed only by the revenues generated from a specific project.